Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the stock market. We're waiting for the FOMC meeting. The last few weeks on the stock market have been volatile to say the least. We saw a rapid 5% correction as we had the Omicron news and the tapering acceleration announcement. Now the market bounced back up to resistance and they're now rejecting here. We recently had an inflation reading of 6.8%. That's the largest inflationary reading since the 1980s. And the market is now waiting for the Federal Reserve to respond to this reading and potentially confirm their tapering of monetary policy, right? If we zoom out on this chart of the S&P 500, we know that the entire reason behind this bull run, this S&P 500 rally, has been monetary policy. It's been QE, it's been stimulus that's being injected into the market. If we start to see tapering here, what's going to happen to the stock market? We're going to discuss that in this video, hopefully making it all clear for you guys. Now, if you're interested in following what's happening in the markets with us, every step of the way, looking at the macro picture, looking at the technicals, and navigating this crazy market, make sure to smash that subscribe button. And now, without further ado, let's get right into it. All right, so I wanted to start off with this chart of the margin debt percentage growth. I think it's a very good idea to put current events, everything that's happening in the market, into perspective with the current market environment. And margin debt is a great representation of the market environment because it tells you how much risk investors are willing to take. Now, we know we had a nice spike here back in 2021 where we had a big percentage growth in the margin debt, similar to the readings we had in 2007, in 2000, back here in 1983, right before the 1983 stock market crash, back here in 1972, right before the markets topped, and again in 1976, right before the markets topped again. So this just shows you the type of environment that we're currently in. We are in an environment where investors are willing to take a lot more risk very rapidly than they were throughout the last few years, throughout the last 10 years, really. Now, although it might seem like we need to be panic selling everything right now based on this chart, I don't think so. And I'm going to talk about that in the rest of this video. But to me, it does say that we're not at the beginning of a bull run here. This is not the type of investor behavior that you see at the beginning of a run. You never get these types of big readings right after market bottoms, right? In 2009, we didn't get that type of reading. In 2003, we didn't get that type of reading. It was nowhere as high. This looks a lot more like end of cycle type of behavior than beginning of cycle type of behavior. But if we put a moving average on this indicator to actually show us how much margin debt we've accumulated over the past 50 weeks, so over the past year, and we're not quite at the upper end of that range, similar to 2008, 2000, 1983. So that tells us that we are in a speculative type of environment. We have investors that are willing to take on a lot of debt very rapidly, but that's a recent phenomenon. And between 2014 and 2020, we actually had a very small amount of margin debt being accumulated, but we're rapidly catching that up as the stock market continues rising and investors continue taking on debt. Now let's get back to the macro side of things. We have this big 6.88% inflationary reading, the largest reading since the 1980s during this big inflationary cycle. We're really starting to get those hot inflationary numbers that we've been talking about for the past few months. And so it's reasonable to expect that the Federal Reserve is going to begin moving more and more towards a tighter monetary policy. And that does change everything that we've been talking about for the past few months. What does that mean for the stock market? That's the big question that we're going to be answering here. A lot of investors are concerned that as soon as the Fed begins to move into monetary tightening, that's going to create a downturn in stocks, and we're going to be seeing the top very quickly, followed by an intense bear market. Now, what I wanted to do in this video is compare the stock market to the actual federal fund rate. Now, there are other ways that the Fed can tighten. They can do quantitative tightening, but looking at their interest rate is a great way of seeing whether they're more leaning towards easing when they're lowering the interest rate or tightening when they're raising the interest rate. Now, obviously, here since March 2020, we've been in this easing environment. They lowered the rate to 0, and that created this big stock market boom. Not only stock market boom, but also a manufacturing boom, a service boom. If we look at the manufacturing PMI, that's a great leading indicator of the manufacturing sector. Since 2020, we had an incredible recovery thanks to that easy monetary policy, thanks to the stimulus. And the same thing applies to the service sector that had an incredible recovery since 2020. In fact, it's still printing record numbers following this big boom cycle. This is really starting to get into some hot numbers, almost as hot as that like button after you smashed it as hard as you can. In all seriousness, do not forget to click on the like button. It helps our videos out, get pushed out to new audiences by the YouTube algorithm. It is really appreciated. But now that inflation is getting a little bit overheated, we saw the economic boom that was needed to not have a recession in the middle of a pandemic, although there are a lot of problems underneath the surface in terms of the real wages when you actually adjust what people are earning versus the actual inflation rate. The average person is a lot worse off than it was before the pandemic, which is what you would expect when you have global shutdowns. But now we're slowly getting into the phase of the cycle where we're moving away from easing and potentially into tightening, right? Similar to 2015 here, in 2004, and in 1993 here. So what does that mean for the stock market? Let's quickly take a look at these 3 examples. After all, that is the data that we currently have. Did it derail the bull market? The answer is a resounding no. In 1993, you had a brief risk-off move following the beginning of the rate hikes, the beginning of the tightening of monetary policy, but the markets eventually recovered and resumed their bull run. In 2004, very, very similar. You had a brief risk-off move as the rate hikes were being announced, but the bull run eventually resumed. The same thing applies to 2015, brief risk-off move as they announced tightening, but the bull market resumes. And I think that's the first big point that I want to highlight in this video. The very beginning of tightening of monetary policy is not what creates a bear market. It's not what's going to create that big bear market that we had in 2008 or that big bear market that we had in 2001. The beginning of tighter monetary policy can only impact the market's reaction to that move. And that can be negative. That can create a little bit of volatility. That's what we've had over the past couple of weeks, a little bit of volatility, but not the end of a bull run. Okay, so when does the bear market actually begin? Are stocks really going to go up forever? Is that what I'm saying? Absolutely not. We know that nothing goes up forever. We know that stocks eventually reverse to the mean, but that happens when monetary policy goes too far, like it did back in 2006 and like it did back here in 2018, 2019, because eventually that tighter policy creates a downturn, right? It's as simple as that. Easy monetary policy creates a boom, and tighter policy creates a downturn. And the first place you start to see where that shows up is in leading economic indicators. This is a great indicator that we love to look at. And look at this, it systematically begins to turn down in 2006 and in 1997 here when monetary policy is too tight. And that's when you have a plunge of these leading economic indicators. You head into a recession. You start to see manufacturing PMIs come down, service PMIs come down. And while all that's happening, the market is pricing that in. It's pricing in the weaker economic numbers. So having the Federal Reserve begin to switch their narrative more into a tighter and hawkish tone, that is definitely a big change in the market. It could create some turbulence, but does that impact the actual economic environment that we're in? Not straight away. Many traders fall into the trap of going into very, very simplistic views of the market. Taper is bad, and so the markets are going to crash, rates rising is bad, and so the markets are going to crash. Unfortunately, the financial markets are not that simple. They're extremely complex, and hopefully these videos put that into perspective for you guys. This is definitely a very, very special type of environment that we're in. The system is clearly pushing its limits here. We're seeing a lot of signs of coming towards the end of a big cycle here. Stock market performance over the last 12 years has been absolutely insane. I think it's normal and reasonable to expect that the next 10 years are not necessarily going to look like the last 10 years. So I think there's no better time to start to educate yourself, to understand how the markets operate, how you can navigate the market properly. And thankfully, we live at a time where information is abundant. We can learn, we have easy access to the information that helps us navigate this market, that helps us protect our capital and gain perspective on our finances. There's absolutely tons of ways that you can access that information online and for free. That's one of our big goals at Game of Trades, is to grow the investment community as much as possible and motivate a maximum number of people to jump into the journey of financial education. And that's an absolute central and core part of our service, is to make our analysis understandable, to make you be able to navigate the market and learn how it's done at the same time. Because if you're not learning and you stay dependent on us, then we failed our job as a service. We're so excited about the many features that we have coming up on our website. We're really trying to make this service as accessible to as many people as possible. Our goal is to keep our prices as low as possible compared to other services to help you access this information, and again, help a maximum number of people learn how to navigate the markets. So let's take a look at the technicals here, jumping back onto the S&P 500 on this 8-hour chart and taking into account the information that we've given in this video. We keep a bullish bias. We keep a bull run bias. We're still living off the stimulus, living off the easy monetary policy that we've had throughout the past year, and that can definitely continue to create gains well into the beginning of the tightening cycle, as we discussed. Now, predicting the short-term price action is incredibly difficult. We don't have a crystal ball. We don't pretend to know where the market is going to go day to day, but I can give you guys some objective opportunities. This bottom of the channel here, that's an objective level of support. It would be a retest of the previous low, maybe a slight undercut of the low, setting up the stage for a nice rally and keeping intact that big bullish structure we have. Now, the problem I do have with that trade is that it's relatively obvious, right? We have these two lows connecting that trend line. We have a beautiful, well-defined price channel. It's a very obvious trade. Now, that doesn't mean it's not going to play out, but when you have a level that everybody's looking at, you can sometimes get whipsaws. So maybe we fall just shy of that level. Maybe we undercut it slightly and dip down into this zone. And that's why I want to quickly jump back on this weekly chart of this bull market price channel, just to remind you guys where we are, right? We broke out above this channel, retested it again. Could we have one final retest? That's possible, right? So if we do have a risk off move here following the acceleration of tapering, could that bring us back into this trend line at around 4,400 points here? So I'd say the best way to summarize this is that we're bullish, we're still in a bull run, and we have a maximum drawdown of around 4,400 points here, with absolutely no guarantee that we're going to be testing that level. Now, hopefully you guys enjoyed this video. If you did, do not forget to click on the like button. Now, in the meantime, I wish you good luck on your trading and see you next time.